the obvious, but I think the second bullet point is more important. When we do the two people in one policy, there's an underwriting advantage that is absolutely huge. Because when we do two people with one policy, they both have access to the long-term care. But now the death benefit is only going to be paid at the second death. We're not going to pay anything when the first one dies because we want benefits for the surviving spouse. So what can you do with a second to die death benefit? You can be more liberal in the underwriting. Now we're not going to take someone that's totally uninsurable, but we can take health conditions that other companies have had to take a pass on as an individual, but as a couple, we're willing to take that gamble. We're willing to take that risk. So I'm not going to go into a lot of detail about the underwriting because at the very end, we're going to talk about the underwriting guide, and I'll give you a list of examples of some of the conditions that we can work with that other companies have had to take a pass on. But there's a huge advantage by being able to do a second to die.
Yeah, I think it's important agents know this. I wrote a couple where he was declined twice, long-term care, just straight long-term care, and I did this policy, and he got preferred rate on a second to die.
Because she was healthy, right?
Yeah, she was healthy, but they gave preferred rates to the guy when he'd already been declined twice on long-term care.
Yeah, let me give you another example. I will give you an example. I had a good friend of mine at church, business owner, 51 years old, very successful, sold his business, he's already retired. Now I live in Pewaukee, Wisconsin, which is just outside of Milwaukee, Wisconsin. Milwaukee, Wisconsin, are there any NML affiliated people in here? No. NML, Northwestern Mutual Life, is their home office is downtown Milwaukee. And so this business owner, like so many other customers in the Milwaukee area, he went to his NML agent and said, I want long-term care for my wife and I, we want lifetime benefits, and we want to write one check for the whole thing. And his NML agent had to tell him, well, we don't have lifetime benefits, the most we can give you is 5 years. You can't do it as a lump sum, you have to pay premiums ongoing, and the rates are not guaranteed. And then when we looked at the health, he said, we can take you, but we can't take your wife because of her diabetes. Her last A1C reading was 8.2, and they said anything over 7.5 is uninsurable with them. We go up to 8.5 on that reading, okay? So he was just kind of sharing with me, you know, what had happened. And I said, well, bring your NML agent in, because I know if they don't offer it, they can broker it. So I said, bring your NML agent in, and let me show you how this works. We were able to do the whole thing. We were able to let him write one lump sum, give him the base contract, add the unlimited lifetime rider with inflation, and with her diabetes, he was really healthy, she's got the insulin, it was controlled enough that we just put a mild rating on here. So instead of the death benefit being here, we took the death benefit down to here, so the monthly benefit was a little bit reduced, but then it was still unlimited lifetime benefits on top. We accomplished all three goals. Lifetime benefits, covering them both, and we did it as a lump sum. So between the base and the paid up rider, they put about $300,000 into this contract. Now that ML agent was thrilled because I had done all the work. All he had to do was get licensed with us and then write the app. That's the smallest case they've given us since then. He only works with business owners. He talks about this now as, this is a stop loss. If you've got someone that's worth 10, 15, 20 million, yes, they could self-fund, but why would you want to have to put all of that money aside if it's something like an Alzheimer's claim where you could take a chunk of it, move it here, turn it into unlimited benefits for you and your spouse, yet if you don't need it, the death benefit's greater than the amount you moved. But that's an example of diabetes. I mean, we run across that all the time. And if it's well controlled, you know, there's some that we have to pass on. But if it's well controlled, here, his company wouldn't take it. We took them right away. 2 reasons. 1, the joint, and 2, that she still fit our parameters. So,
if I could interject, I can hear you already, the cars are turning about all these cases you had declined. We're going to get a ton of apps. There is a way to get through this, and that is a form that Jennifer has where you put on the health, we email it into underwriting, they get back to us in 4 hours. And they'll say, yes, and here's your parameters that you can write. That's pretty good insurance going into a house that you know you got a pretty good chance to write a case that everybody else has declined.
and I mentioned that underwriting was going to be at the very end. So I have a copy of that form that I was going to give everybody, so you have one sample. But Jim's exactly right. You know, one of the places that we encourage people to start is go back to those people that you quoted that didn't buy, and we'll show them an AssetCare 4, I'll get to that in a minute. Go back to those people that you quoted that did buy but didn't qualify, and let's take a look. Because with our joint policy and with our underwriting being a little bit more liberal, we're still tightening up just like everybody else. We're able to place a lot of cases that other companies wouldn't. So AssetCare 1, I think that we handed out the illustration. You all have a copy of the illustration. The concept here, I wanted to give you the illustration that was pretty close to what they used in the PowerPoint presentation. So this is that couple that said, well, if it happens to me, we'll liquidate that CD. We've got $125,000. So I want to show them, well, we're going to take that $125,000 and we're going to turn it into $250,000 of death benefit. And now, what we do, once your deductible period is taken care of, it's 30 days for home care, 60 days for anything else. Once we start paying, from day one from the time we pay, we can get all of that death benefit out in 50 months. 50 months, all right? So what does that mean? We're taking out 2%. Our starting point, if you don't ask for something different, the computer defaults to take 2% of the death benefit. So if we take 2% of $250,000, that's $5,000 per month. So if either one of these two requires care and it's expensive, we can go all the way up to, we'll pay up to the actual cost, not to exceed the monthly limit here, which is $5,000. So if they're pulling the full $5,000 a month out, it would last 50 months or just over 4 years before they've exhausted all the death benefit. So instead of using their $125,000, we're stretching it to $250,000 and it's all tax-free. So either one of them, up to $5,000 per month, and it would last for 4 years. Well, what if they were both on claim? They do not split this. It's 2% each. So they both have access up to $5,000 per month. If that's the case, now we're going to go through it in a shorter period of time. So they each have access to the full monthly limit up to the death benefit. They use the death benefit first. Now when the death benefit's gone, we get to the rider. Now we call it the continuation of benefits rider, and we're going to go through the illustration in a minute, and I'll point this out. Well over 75%. I think it's closing in on low 80s now. A little over 80% of all of our contracts, they take the rider. They want the rider on top. What does the rider say? The rider says you have a choice. You can either double your existing pool of funds. So the first $250,000 would come from the death benefit, the next $200,000 from the rider. So now you have $500,000 total. That's not bad. But what's my favorite? What are we able to do that nobody else is doing? I want to show them unlimited lifetime benefits. Okay? And typically, on the lifetime benefits, we'll also add inflation. So it's an increasing benefit. And you can see here, we're showing here that it's a very affordable premium. I'm going to get to that in the illustration, how do you pay for this. But the key here is, we've taken their deposit, we've repositioned it, we've set up a death benefit, and then we've added unlimited lifetime benefit on top. So if they need care, we've stretched it out to benefits forever. If they don't need it, this cash is still growing. If they don't need that, this death benefit gets paid when they die. So something is always paid out. Now, we can write this from 40 to 80, and we use actual age, not closest birthday. We can do it on an individual basis, or we can use that patented joint life. Now, when we're talking about liquid funds, AssetCare 1 is specifically for non-qualified dollars. When we're talking about AssetCare 1, it's any two people with an insurable interest. So it's almost always a husband and wife, traditional husband and wife. It doesn't have to be. It can be a same-sex couple. It can be a brother and sister. It can be two business partners. It could be a father, daughter. The only requirement is there cannot be more than a difference of more than 25 years in age. So if it's 26 or more, we're out of luck. If it's 25 or less, we can do it. So I could not go in with one of my daughters. I was 28 when my first daughter was born. So that leaves me out. But for people that started their families before they were 25, they could go in with one of their children. Now why would you do that? What if you've got a widow that's 72 or 73 in poor health, so it's going to be a little harder to qualify as an individual, she could go in with her daughter, lowers the joint age, so it's a little bit more benefit for the same deposit, and a better chance of getting approved. Because how much are we gonna pay when mom dies? Nothing. It's a second to die benefit. So this works well, knowing that it's any two people with an insurable interest. So this talks a little bit about the parameters. I'm gonna show you the actual illustration, so let's just talk about this illustration for a minute. So on this illustration, you've got a couple, joint age of 62, they put in 125,000. Shows here the death benefit was a little over 250, it was just under 270,000. If we can take out 2% per month, now we know we're using 2% because right underneath the death benefit long-term care balance, it says benefit period, it's got 50, 50, that's 2%. 50 goes into 100, 2%, 2 times, right? All right, so that's your $5,400 per month per person. On the bottom, I like the little chart that they use. We're using the death benefit first, and when that's gone, now we've got the open-ended, unlimited lifetime rider. So this is just a little summary page. But let's go to your second page. Your second page has got a legend. It shows the 125,000 being submitted. Now go over, now you can see that the next column over is the accumulated value or the cash value. You can see it starts at 103,000. So there's a sales charge associated with this. But it doesn't make any difference because look at the next column over to that. What is the guaranteed surrender value? We have a sales charge and we have a first-year sales charge and we have a 10-year decreasing surrender charge. But we still tell people, this is always in year one, every one of these is guaranteed return of premium. So to change your mind, cash value was 103,000, but we'll give you your 125 back. We don't want that ever to be a stumbling block for them not moving forward. But even beyond that, you know, and you can see for the first 10 years, there's a slight difference between the cash value and the surrender value. It's gone after 10 years. From year 11 on, the cash value and the surrender value are the same. Even with the surrender value down the road, if we apply the surrender charge and it's less than what they put in, if they chose to take it out over 50 months, we guarantee their principal for the life of the contract. So if you ever want to walk away, you can never get back less than what you put in. That's huge. There's very few places where you can do that. You have a question?
We do. So it's not unusual for me to see husbands and wives that were having a Medicaid conversation. And so if this is a joint life contract, is there a situation where it can become, where a change of ownership can be done to just make it a single life?
Are you saying because for Medicaid reasons you don't want this as an asset? No. What's going to happen is it's a joint contract, and so what will happen is one of them goes in. It's joint benefits. So we would go through the death benefit first. When that's gone, now we would go to the unlimited lifetime rider. So there's benefits for that person that's in the home. The cash value won't. The question is, would we look at the cash value as an asset that they have to liquidate? We're trying to avoid those situations.
I know you are, but unfortunately, the reality is it doesn't always avoid that. So what happens sometimes is we have, like I had 5 married couples last month that we did Medicaid on. So unfortunately, for the person who's in the nursing home, clearly if we're working on Medicaid, they can't have more than 2,000.
Yeah.
That cash value counts against that.
If-
So I think I just want to be clear on change of ownership. Can a change of ownership be made to a trust?
No.
Okay.
The problem is, you put it into a trust, what's going to happen is, if you have death benefit long-term care, that's the accelerated death benefit to long-term care, that's considered instance of ownership, so it defeats the purpose of putting it in the trust. So the bottom line is, if they're in the group that doesn't have a lot of assets and they're thinking about the Medicaid approach, this is probably not the best asset. This is probably not the best approach.
Actually, that whole concept of not enough assets is a very interesting one because I've been working on Medicaid cases where we're talking about assets of 200 to 500,000.
Yeah.
So that's not a little bit of assets,
Yeah.
that's quite a bit.
Yeah,
So
and we
I just
started
wanna
by.
make sure I'm using the
Yeah.
planning tool that's most appropriate if you,
Yeah.
if you.
Yeah, and that's why they say, is there a line? And there isn't. You can see, like you said, 200 to 500,000. For a while, in one of our brochures, we said that in addition to their home, they should have at least 300,000 of invested assets. And so, and then we said, we don't even want to have a line anymore because there's a few people above that that this isn't the best fit because they're still going to end up using Medicaid. Or there's people below that say, well, I still like this as the way I want to go, and I'll take that.
I have a question. In regard to her case, if the couple becomes divorced,
We have to
what
split.
happens to the policy?
If it's an amicable divorce, which I certainly am not familiar with.
Are there any?
Yeah. If it was an amicable divorce and they understand that the policy benefits both of them, they can just have a statement that they have on file that says, we're just gonna keep it in force because we both have the benefits. They don't have to split it. More often than not, what happens though is we have to liquidate it. There is no way to split it from a joint to individual policies. Underwriting won't do that. It's a different risk altogether. So they would just have to liquidate it and split the assets then.
So in this case, just on your second, like if you look on the first page where it has the subsequent annual premium is $3,032. So if that means that they're gonna have to kick in $3,000 a year to keep that COB and
Yeah,
so
we're gonna get
So
there.
if they were divorced, then somebody would have to ante up and pay
Yeah.
that, or they'd have to split it.
1,500 each, yeah.
All right, it's a little messy.
Well, nobody takes one of these out thinking that they're gonna get divorced, so,
of course
yeah.
not.
Alright, so we have the guaranteed principal of slow, steady cash value growth. Now, this is a whole life chassis. We're at the guaranteed minimum interest rate of 4%. So what you're gonna find is they're netting, in this case, they're netting between 1.5 and 1 3/4 tax deferred. So what's the bank paying right now on a CD? About 1/4%, and it's taxable. So what we're actually showing them is, this is actually safe. You can never get back less than your principal, and it's slow, steady buildup that actually outperforms your CD. And oh, by the way, if you or your spouse get sick, now we're turning it into this lifetime benefit for care. So the fact that it's got this, not just a guarantee of principal, but slow, steady cash growth, that's the advantage of having a whole life chassis. Our closest competitor in this market uses a guaranteed UL chassis. And you have to make a decision with them. Either I want guarantee of principal, but then there's no growth, that's all I ever get back if I change my mind. Or I'll give up the guaranteed principal, I'll take an increase in cash value, but then in the early years, you're gonna get hit with a surrender charge. We have both. We have the guaranteed principal and the slow, steady growth. Turn this to page 3, your next page, because this talks about that rider. And the second paragraph, it says long-term care benefit continuation rider. If you look at the second or third sentence from the bottom of that paragraph, that's right in the middle there, it says, the rider is non-cancelable. What does that mean? It means your premium cannot be increased and we can make no changes. You want to point that out over and over again. That's one of the big concerns people have with traditional long-term care. This can never go up. What do people like at retirement? Something that's fixed because it's easier to budget for. So that's what we point out, this is non-cancelable. Turn this one more page. You have 2 ways that you can pay for this rider. 2 ways that you can pay for this rider. You can either pay for the rider annually, and it's guaranteed never to increase, or you can pay for it as a lump sum. So if we take a look at the boxes on this page, you can see in the left-hand column, what I'm going to do here is we're going to go to, on the top it's the single premium, the lifetime coverage, and if they wanted 3% compound inflation, which that's in the middle, that's the most common one right now, you can see that the lump sum would have been $53,520. So 125 in the base, 53, so a little over 175, between 175 and 180,000 total, and then they're done, right? If they said, I don't have that extra CD, I want to put as much into the base as possible, and I'll pay for the rider annually, something that's guaranteed never to go up, I can afford that. You can see here, the lifetime coverage with a 3% compound inflation is $3,032. So we always break it out. You have a couple of different ways that you can pay for it. One last thing to point out, go to the last page here. This shows the effect of compound inflation on your benefit. So it started out at just under $5,400 a month, and by year 10, it's at $7,000 a month, and by year 20, it's at $9,400 a month. This is the page that's most frequently misunderstood, because customers will come back and say, so if I have a claim in year 20, I can take out $9,400 a month, and the answer is no. You're going to, in year 20, you're going to take out $5,400 a month until you go through this death benefit. See, you've got $5,000, well, it was actually $5,400. You go through the death benefit first. When the death benefit's gone, now you go to the rider, and you don't have to start at the top. So if the claim started in year 20, they would get $5,400 a month for the first 4 years, and when that's gone, now they would go to the rider. So you can see by, we're not showing every year here, we're showing every 5 years from year 20, that you can see it's going to be, the first monthly payment available to them after the death benefit runs out is going to be someplace around $10,000 a month each. And how long would it last? Unlimited. So you always want to make sure they understand, you go through the base benefit first and then the rider second. The rider has the inflation on it, the base benefit is level. So that's one of the questions people have is, how can we offer lifetime benefits when every other company has said that it's no longer feasible, it's too expensive? Well, because we don't go to the rider with the inflation until you go through the death benefit first. Does that make sense?
So is
Now-
one of the options that they can drop the rider if they want to at some point in time?
You can always drop the rider, but you would not be able to pick, to get it back.
Right.
So, one last thing to point out about this first example, and then we'll move on. I took a lot more time on asset here one because it's the base. If you understand this, you'll get everything else. So what if the customer said, I love this, live, die, or quit, something's always paid out, this is what I was looking for, but here's the problem. You're at $5,000 a month, and I know in my area, we've got some friends, their parents are in, that's not enough monthly benefit. So you say, well, do you have another CD? No, I don't have another CD. Now, some benefit is better than none. We can go through that whole story, but the bottom line is, they just would feel better if they had a higher monthly benefit. So what are their options if they don't have more money to put in? This is our starting point. Use $200,000 as a death benefit. If you have $200,000 and you take 2%, that's $4,000 a month for 50 months. What if you said, I can squeeze it into a smaller period of time. If you take 3%, 3% into 100 is 33 months. If I squeeze it into 33 months, 3% of $200,000 is $6,000 a month. I'm up to $6,000 a month instead of 4 because I'm squeezing it to a shorter time. Or what if I came all the way up to 4%? If I take 4% of the death benefit, 4% of $200,000, now I'm at $8,000 a month. All right? So we can give you a higher monthly benefit if you squeeze the death benefit into a shorter period of time. Does that make sense? Now, the logical statement would be, well, why not show everybody 4%? Because the rider has to be affordable. We want them to be in a situation where it'll never go up once it's issued, but we want to make sure it's a rider that they can afford. So, your choices for the rider are always double or lifetime. You can't take 33 on the base and 50 on the rider. It's always going to be double or lifetime. When you go from here to here, you're not just doubling the premium for the rider. You're more than doubling for 2 reasons. We doubled the monthly benefit. We went from, in this case, $4,000 to $8,000, but also, more importantly, we cut the waiting period in half before the lifetime rider kicks in. So not only is the lifetime rider paying out a higher monthly benefit, but we're going to get to it in a shorter period of time. I tried to illustrate that for you by just putting a little spreadsheet on this next page. So if you take a look at the top example on the left, here's a couple put 100,000 in, it's just under 200,000 death benefit. If they use 2%, they have about 4,000 a month for the first 50 months. Go all the way over to the far right. If they wanted lifetime coverage for both of them and they want 5% compound inflation, the annual premium is $4,000 a year, guaranteed never to go up, okay? Now, if they said I need more monthly benefit, come down one line over here. If they did 3%, now they're at $5,700 a month because it's coming out in 33 months. If they want to stay at 5% compound inflation for lifetime coverage, it's up to $9,000. So maybe you say, well, you don't have to do 5%, you can come down. We can do 2, 3, or 4% as well. So what's happening is we're seeing that 3% has become the more common amount when we do anything other than 2. If you do 2% up here, if you spread the death benefit out over 50 months, then we'll still see quite a few of the 5% compound inflations put on. But if you do either of these, the more common number is 3% compound inflation, which you can see in this example keeps it still affordable.
And this all has to be done at time of application.
Time of application.
There's no changing in the,
Yeah, exactly. So what we've done here is we've said, yeah, we've got a lot of these choices, and you don't have to be an expert at this. You got people that are experts. You have, Jim and people here at Life Solutions that are experts at this. So you tell them, what are they trying to accomplish? They really want the lifetime benefit. They have to have some type of inflation on there. But what can they afford for that ongoing premium if they don't want to do all the lump sum? Well, they can afford X number a year. $6,000 a year is their top. That's the most they can pay. Well, then you can balance that and see what's the best way to set this up so we can get that objective. Does that make sense? All right, good.
This is also an expense policy, not an indemnity. So you're gonna-
Reimbursement.
That's
Yeah,
just
reimbursement contract.
reimbursement. So if you're in home health care, you may pull less out each month, but your bucket will last longer than 33 months or 50 months, okay?
Question of reimbursement. Okay, this is a reimbursement policy. Okay, so it doesn't matter in-home, assisted living, or nursing home.
Correct. And they're all listed on that cover page up in front. So you'll see there, even in adult daycare is added as well.
They're TQ triggers. So you trip the triggers like you would traditional long-term care. Now you're addressing the claim.
If it's a joint policy and say the first person's on, they would pay for 2 months and then they pass away.
Yep.
How does that?
All right, so we had $5,000 a month benefit. So let's say that they met their deductible, and then we paid 2 months of claims out at $5,000 a month. So $10,000 came off the death benefit. So that death benefit we were estimating was $250. Now it's down to $240. So now for the surviving spouse, if they need care, we go through the $240 of death benefit that's remaining, and then we go to the unlimited lifetime benefit. If they never use it, $240 is the amount that passes to the beneficiary. You do anything to say? Yeah. If they wanted to pay for that rider annually, they do that right up front. So, so it'd be moving, in this case, it was 125 into the base, they reposition that asset. And when some people say, well, I can't afford to spend that much, they're not spending anything on the base, they're just repositioning the asset, because they walk away, how much do they get back? All. It's only the ongoing payments that does not have a cash value. So they would reposition the base of 125 and write out the first check for $3,000.
I have a question,
Yep.
tax question. Question number one. If this is a life insurance policy, then I cannot deduct my premium on my 1040 form, correct?
On the base policy, that's correct. Now, go to the rider. The rider is pure long-term care coverage, so the cost of the rider you can't use.
So it's health insurance. Second question, 10 years have gone by, and I start to draw money out, and I have more than the basis of what I put into the life insurance contract. When I receive that benefit, is part of it taxable? Because it's more, you're getting gain back. It's your own money, so you're getting gain back first.
You're making up well, first of all, we're always discouraging people from dipping into the cash value in emergencies. Second, now you want to take money out of the base every year?
No.
Or what?
If 10 years go by,
Yeah.
and then I go on claim,
You go on claim,
and I've got an excess, there's
Okay.
$19,000 of
Okay.
excess.
at claim, forget about the cash, because the claim is 100% tied to the death benefit, so it's all income tax free. So you're gonna go through,
So that's
what's gonna
different.
happen is, as we reduce the death benefit, proportionately it reduces the cash value. So at the end of the death benefit, the cash value is gone as well. So it's impossible to have any cash left if the death benefit's been exhausted for care.
I'm not talking about cash left. If, in a normal life insurance contract, if I have a $14,000 gain and I start to draw out money We're either gonna pay on dividends,
We're not
taxes.
taking out your cash though. You understand? We're
Which
not.
cash are we
we're-
taking out?
We're taking the death benefit. So the company, it's set up, and this is all approved by the government, this is a qualified plan. It's a reduct, you're not taking the cash value out, it's set up, you read the policy, it's coming out as the death benefit, and because it's coming out of the death benefit, it's coming out 100% income tax free. Now, what we have to do is, we have to, so that there isn't a tax consequence, we have to proportionately reduce the cash value as the death benefit comes down, so they don't theoretically have cash left after the death benefit's gone, then there'd be a taxable event. So,
Okay, well,
it's just, and because it's a prepayment of the death benefit, there is no taxable event at the time of the claim.
so do you have a spreadsheet that details that explicitly? Because in the new Department of Labor fiduciary rule, it mandates that an agent must divulge all means of cash dissemination. And this one is a lawsuit waiting to happen if you don't have something and strictly go to the life.
More and more pieces are being designed because of the DOL, but now the other part of that is, this is all fixed products too. So, most of this is not under the DOL requirements. They have exempt contracts, and AssetCare 1, AssetCare 3, AssetCare 4 are all exempt products. The only product right now that we have to change is our indexed annuity care. That product is no longer going to take qualified money because of the DOL. But no,
With all due respect, the agent out in California who took 4 years to settle his claim,
Mhm.
he also had a fixed product, and it had no bearing whatsoever on the proceedings.
Yeah.
So I'm saying,
We can put something together that would show how the claims are paid, how it does bring the cash value down as the death benefit comes down, and that has not changed. It's just now we just have to illustrate that for somebody on the claim. So AssetCare 3, I'm glad, and your name is?
David Van
I'm glad David brought up the DOL because that's a huge issue, and AssetCare 3 is exempt. And so the neat thing about this is there's $23 trillion, almost $24 trillion of retirement assets, qualified retirement assets in the United States as of the end of last year. And as of now, since we came out with this product in 1992 for qualified money, we're the only ones that are doing qualified money, retirement dollars, into a combo plan, a life long-term care plan. So we want to talk about AssetCare 3. The first thing that you'll notice is that at the time of a claim, it's set up exactly the same way. You go through all of the death benefit first in 50 months. Now keep in mind, you could change this to 33. If you change this to 33, then the rider would say 33 or life. But we're taking the death benefit out in 50 months, and then we have the unlimited lifetime rider. So what's different? What's different is how we're going to fund it. We want to fund it using qualified money. We want to use somebody's retirement money. Now the first thing that we point out is it can be 401k, 403b, IRA money, TSA money. The first thing that we have to point out though is you cannot be an active participant in the plan. So for example, I've been in financial services